comes to 19. So that means company earns profit, or the difference shows that the incremental revenue is higher than the differential cost at the last level. Now, on the basis of these comparisons and the differences, on which particular level company earns maximum profit, or simultaneously they can continue the production also. If you identify, the identification may be right, that at the level of 1.60 lakh units manufactured or output, company earns 24 lakh rupees profit more. So the company should continue the production at the level of 1.60, where they were earning a profit more on the basis of the comparison of differential cost and incremental revenue. This is what all about the first method, differential cost and incremental revenue. So now moving to the next method, and the next method is make or buy decision. Make or buy decision, it shows that whether the company have enough resources and the production capacity as well as the working hours in the firm that the company manufactured that part in the premises, or it can be purchased from outside. Which one is beneficial for a company? So here the company have a comparisons of the unit manufactured in the premises, or the cost has been given if it is to be purchased from outside. Which one is beneficial? And that is what we need to compare. I'm taking a second questions that related to a make or buy decision. As I mentioned, you need to refer the question in the presentation area. See here, the question is, the Sony company produces most of its radio. I'm just giving a brief about this question. You may be having a questions in front of you only. So where the company is having a feasibility buying of that unit from outside, then they need to spend 4.50 rupees per unit. Other than that, the company need to spend 1000 rupees additional purchase cost also. So that means there are two costs if they are going to purchase from outside. One is 4.50 rupees for the purchasing of that one unit, as well as the additional cost total 1000 rupees. Under that consideration, that if they manufactured that numerous unit other than the purchasing from outside, then they need to control, so discontinue the production of the part. Department 1 would have somewhat reduced their operation. So here that one consideration is, if they are going to manufacture that part inside the premises, they need to control and reducing one production department up to certain level. Their average monthly usage production of that part is 20,000. So that is very important. That is another important information. The monthly production of that particular part is 20,000 unit, and the cost of production of that part is given: material per unit, labor, that is also per unit, fixed overheads, that is 0.80, and total cost is given. But when you are seeing the labor is given half hour, 2.40 for half hour. How many units they are manufacturing? 20,000 units, and that is per unit. So labor is given half hour per unit. It means that they manufacture 20,000 units. How many hours they need? 10,000 hours. So it means the company need 10,000 more hours. This is just for your information. All right. So now we will see how it would be actually calculated a differential cost. How would be calculated a differential cost and the costing structure for taking a decision analysis. So decision analysis, you can take it with this calculation of this table. All of you just concentrate here how it would be calculated. Now here, this is a particular part. Then two partition. The one is maybe company is going to manufacture that product, making cost, and making cost in two parts. One is quantity. Quantity is already mentioned, so no need to write the quantity here. So direct amount and per unit cost. Per unit and value. And in the case of instead of making, now if it is buy from outside, what would be the situation if it is buy? It's by cost, and that is also per unit if it is given. and the value. This is what all about. We have an information. Now from this information we'll just identify how the cost would be incurred. Just see the question. Let's see, the first calculation is the material cost. It is relevant cost. Relevant cost because of the cost is directly affected to the manufacturing of the product, and we have a material cost first. That material cost is given 1.80 rupees per unit. 1.80 rupees per unit, and it is mentioned in the previous line the average monthly usage production of this part is 20,000 units. So 20,000 into 1.80, it comes to 36,000 rupees. The total value, it comes to 36,000 rupees. Then the labor cost is given 2.40, that is half hour, but labor cost is given per unit, it is 2.40. Again 20,000 units are going to manufacture, so it comes to 48,000 rupees. So here we have a labor cost is 48,000 rupees on the basis of 2.40 per unit. Now we would be identified for buying cost, and that is, first is purchase cost. Purchase cost is given in the question, that is 4.5 rupees per unit. 4.5 rupees per unit, it's clearly given in the question, and we are supposed to require 20,000 units. So 20,000 into 4.5, it comes to 90,000 rupees. That means if the company purchasing the same unit from outside, they need to spend 90,000 rupees only for purchasing that units from the particular company, from where they are actually try to arrange that particular product and this part. And one more cost is there, and that is additional cost. Additional cost incurred, that is 1,000 rupees. 1,000 rupees is total is given. So if you want to find out per unit cost, 1,000 divided by 20,000 units, 1,000 rupees divided by 20,000 units comes to 0.05. 0.05. This is your per unit cost. 1,000 they have an additional purchase cost, so that is also write down under the buying cost. This is what all about. We have a total amount of costing is concerned. Now we'll just make a total, and then we will find out the differential cost. We were here, incremental revenue is not concerned because of the revenue is not a part. We just need to take a decision on the basis of a comparison of cost, whether the cost is incurred more in case of a manufacturing of the unit in the premises, or cost is incurred higher in case of if it is purchased from outside. So just see the how much amount of cost is incurred here, the total cost. Here in case of this 4.20 and 84,000, this is 4.55 and it's 91,000. So in this case, if you just identify the amount of cost incurred in case of making this product, it is 84,000, and if you are purchasing from outside, it comes to 91,000. Even that it's very clearly identified, then the per unit cost is making per unit cost is cheaper than the buying cost from outside, as well as in the total value also. So what would be the differential cost? Your differential cost is, if you identify, that is 91,000 in case of buying from outside, and 84,000 is making from in the premises. Its difference shows 7,000 rupees. 7,000 rupees, it's your differential cost, and as well as it is favorable in case of 0.35. Differential cost 0.35, that is from the business is concerned. So if you are going to see, the company should go for the manufacturing this part in the premises, and it is comfortable to continue the amount of manufacturing in the premises, because of they would be beneficial with the value of differential cost of rupees 7,000 as well as the per unit rupees 0.35. Instead of that, the unfavorable volume variances, as it is mentioned in the question, that there is some unfavorable volume variances is there, and that unfavorable volume variances if you are going to see that the 16,000 rupees per month in the department. So if you have a 16,000 rupees per month in this department, how many working hours loss we have? See here, working hours is not loss actually, but working hours will be used for the manufacturing of this part. Here it is using half an hour, and half an hour it's required for 20,000 units. So that means the total 10,000 hours is required. So in case of 10,000 hours is required and 16,000 rupees is an unfavorable volume. So if you are going to see 16,000 divided by 10,000 hours, it comes to 1.60 rupees. So 1.60 rupees is actually indicates that there is no alternative use of facilities. There would be remaining idle part of production is actually discontinued. So therefore they are irrelevant cost, and that's why the company needs to take a decision that they should practice to produce a part in the department itself only because of this concern. That is what the make or buy decision. Now moving to the next method, that the company needs to take a decision whether they can have enough amount of a production capacity, then the company can try to manage the domestic sales as well as they can move further for their selling the products in a foreign market also. So it is a decision regarding the company can accept their foreign export order also or foreign market sales also or not, and that is to be taking a decision on the basis of a certain criteria and the comparison of a selling price in the domestic market as well as in the foreign market, and what would be the change in case of the fixed cost. Here the marginal costing concept would be directly affected. For that you need to refer your question in the video lectures presentation problems, where the question is given, that is sales in a foreign market. The question is a company, I'll note down the certain important things would be here, and then we find out the certain amount of calculations. Last, the question is a company possesses an installed capacity to manufacture 1 lakh units. That means they have a total capacity is 1 lakh units. That is installed capacity. So company have an installed capacity of 1 lakh units. The marginal cost of manufacturing is 0.15. So variable cost is 0.15 per unit. So company have a 0.15 per unit marginal cost, whereas the total fixed costs are given rupees 40,000. So the fixed cost is rupees 40,000. So company have a 40,000 rupees of fixed cost. Company works at 80% of their production capacity. That means at present capacity utilization is 80%. So company is working presently at 80% of capacity utilization, and it has a fixed its selling price of rupees 0.75 per unit. It means the company's selling price in domestic market is rupees 0.75 per unit. This is their selling price per unit. If a company receives, now the question is beginning, if a company receives an order from the foreign market and foreign dealer to purchase a remaining production of 20% of capacity. So now export order is received for remaining 20% capacity. Remaining 20% capacity. So for this 20% capacity, and they ask to sell out this product at the price of 0.50 per unit. So selling price for export order comes to 0.50 per unit. Rupees 0.50 per unit. So if you are going to compare the selling price in the domestic market and the foreign market, it shows clear-cut differences where the decision has to be taken. And if this proposal does not affect the selling price in the local market, then what would your advice to accept this offer? So the company has to take a decision for the certain part of calculations, and on the basis of that calculations they need to identify whether the company can move for this decision or not. Let's see, and that the basis of these calculations we would be identified what amount of their total contribution in the domestic market. So in the case of the domestic market contributions, let's see. The first is we'll calculate it the what amount of their present capacity in unit. So capacity in units, total capacity is 1 lakh and 80% is actually presently usage. So that means 80,000 units they are selling in domestic market. So the domestic market sales is 80,000. Now we'll just identify the how much amount of the sales price they have. Selling price, it is 80,000 units multiplied by 0.75 rupees per unit. So 80,000 units into 0.75, it comes to 60,000 rupees. Their sales comes to 60,000 rupees. Right? Now we'll find out the contribution. So their contribution, it comes with S minus V. As I already mentioned, we'll have to use the formula and concept of marginal costing. So S is rupees 60,000. Variable cost is given 0.15. So we need to calculate variable cost here. And variable cost is 80,000 units into 0.15 per unit, and it comes 12,000. So 12,000 it's their variable cost. So that rupees 48,000 is their contribution. 48,000 rupees it's their contribution. Is that clear? So it means that the company have a 48,000 rupees of contribution after the selling of 80,000 units in a domestic market. Now let's see what would be the profitability. Profit is equal to contribution minus fixed cost. So here the contribution is 48,000. Fixed cost is given